Hey everyone, happy Thursday, November 16th. It's about 11:20 on the West Coast, and it's time for another market update. Rates have been on a nice little run the last couple of weeks. We went, got above 8 for a little bit there, the average conventional, and we were down to 7.5 last week. So let's see where things went this week. Starting off, the first thing we got on Tuesday was the ever important October CPI inflation data. Fed's paying really close to inflation. Inflation's the reason rates have got so high, the reason they started their rate hikes. And that came in flat for the headline, and core went up, but dropped year over year, and it beat estimates. So this was a really good number for us. So let's take a closer look. Like I said, headlines stayed flat, but year over year dropped from 3.7 to 3.2, so a nice 0.5% drop. Core went up 0.2%, but boy, that works. Replacing last year's October. Year over year dropped from 4.1 to 4.0. Keep in mind that the Fed's target is about 2% on that core rate, so still some room to go. And then taking a look at the closer stuff here at the shelter rent, owner's equivalent rent. This is a big part of the core, and that's been coming down, not as fast as we'd like. And we'll take a closer look at that in a second. Still going up month over month, but slowing down year over year. And then we got some help on lodging away from home. We got some help on the headline for energy. Oil and gas prices are coming down. And in fact, they went down more today. So, if they reran these numbers now or for November, we're going to see hopefully even more gains there. Used cars continue to come down. One thing I wanted to point out, motor vehicle insurance went up 1.9%. That takes up 3.5% of the core. Now, year over year, that is up 19%. Because of things like more claims, flooding, I think car thefts are at a 15-year high. And so, it's part of the core, but the Fed rate hikes they have no effect on that. The Fed hiking their rates, making rates higher is not going to slow down car thefts. So that's not going to have any effect on the insurance number. So if we actually took that out of core, we'd be down to 3.3 instead of 4% on that core number. So just something to keep in mind that, it's affecting us, but really that's not because of the economy. That's not inflation. That's theft and things like that, and just insurance costs going up. And then taking a closer look at the inflation or at the shelter inflation. So as we talked about, this is about 44% part of the core. Right now, we can see the blended core logic, so this is renewals and new rents, is about 2.9% increase year over year. The CPI, what we just got this new data is showing that it's still at 6.7%. So as you can see, this has been coming down for quite a while in the real world. In these inflation reports, it took longer to hit that bump and start to come down. So the benefit of this is going forward, we can expect more gains going forward because it's going to be catching up to the real numbers in the future. So if you look at the math right here, if we just took away that lag effect, the core would actually go from 4 to 2.3. So that's a big difference. So next thing we got was October PPI. So different than CPI. CPI, that's consumer inflation. The PPI is that's producer inflation. So this is a good one to look at because it tends to be what's going to happen in the future. So if it's costing them less to produce goods, then hopefully that price break would pass on to us as consumers. So that actually came in at the biggest drop since April of 2020. So another, good news for us here in the bond world. So as you can see, month over month, it was estimated to come in at plus 0.1%. It came in at negative 0.5. And then year over year, it was supposed to be, it was at 2.2% previously, and now it's at 1.3%. So really, really low producer price inflation. So that's good to see because, again, that should transfer to us as the consumers. And then core, even at core, it was supposed to go up 0.3, didn't go up at all. And year over year, that dropped from 2.7 to 2.4. So again, the headline, that's a lot had to do with gas and energy prices. But core staying flat, that doesn't include gas. So that's good to see that, at least their prices are going down. Next thing we got was October retail sales. So this actually hurt us a little bit. It's slowing though. It's supposed to go down about negative 0.2%. It went down negative 0.1%. So retail sales, this is us spending money, shopping, doing things like that. But if you take a closer look at these numbers, it looks like people are spending less money on non-discretionary or discretionary items and more money on non-discretionary. So basically, we're spending less money on things we don't need and spending more money on things we absolutely have to have. So that again is a sign of as a consumer, we're slowing down. And again, we're putting a lot of stuff on credit cards, things like that. So, just another sign that the economy could be slowing down, and that, helps us in the bond market because it makes the Fed quit what they've been doing with rate hikes and then hopefully, go to rate cuts. So the next thing, we got new job claims. There were 231,000 new unemployment claims. 220,000 were estimated. So still a pretty low number, 231, but it shows it's going up. Continuing claims went up again. So basically what it shows is, employers are trying to hold on to employees, but when people do lose jobs, they're having a harder and harder time finding job afterwards. So again, probably the last thing that's going to change in the job market. First is job openings and things like that, but something the Fed's paying close attention to. So the higher this claim number gets, the better it's going to be for mortgage rates. Miscellaneous. So this is something I want to get into. When might the Fed cut rates? So we have another meeting come up December 13th. But right now, the Fed fund futures cut odds. Right now, they're saying no chance that they're going to cut in December. They're also saying no chance, really. It's like 99.7% chance that they're going to hold steady. So no hike either. So that's great. But as you can see, starting in March, really, this is when there's the futures markets are starting to price in the Fed cutting rates. And really, about May 1st, it looks like is when it tips over into more likely than not. Right now, so this is what we want. Once the Fed starts cutting rates, that's when you're going to really see mortgage rates start to head down. So, hopefully this holds true. And then if we get weaker employment, weaker inflation data, maybe in this March meeting is when they make the first cut. That would probably mean the economy is in a little bit of trouble, but we do want the Fed to cut and hopefully help us with rates. Next thing we got here. So average 30-year conventional. So last week after I had finished my video, it had ended the day about 7.55%, the average conventional for a good borrower. That's down to 7.36. So nice, almost 0.20, a fifth of a point a drop in a week with this good inflation data. So hopefully that continues. Next thing we got, important dates. So we got the PCE report coming out November 30th. Then we got another BLS jobs report. That's important. Then another one, the CPI reports. And then we get that Fed meeting December 13th. Like I said, right now, it looks like the markets are saying they're going to pause. So no hike, no cut. And let's just hope nothing changes in the meantime to make them decide to hike again. But it looks like they're in the pause mode right now. So good to see the inflation slowing down. Not necessarily good to see the economy slowing down, but if that's what it takes for the Fed to stop hiking rates and to cut rates, that's, I guess, a necessary evil. So I hope everybody has a great week. I'm going to do my video next Wednesday instead of Thursday, since Thursday is Thanksgiving. So be on the lookout for that. And if you need anything at all, please don't hesitate to reach out. I'd be more than happy to help. Have a great day, everybody.